March 27th, 1980. The silver market is in freefall. One family owes over $1 billion to a chain of banks and brokers. Today, they can't pay. By the close, minus a third. Brokerage firms are on the brink. The Federal Reserve is making emergency calls to prevent a cascade of failures across Wall Street. All of this because two Texas brothers decided they could corner one of the oldest metals known to man. This is the story of Silver Thursday. To understand how two men nearly broke the financial system, you have to understand what they believed and why they believed it so completely that no amount of money could make them sell. Harrelson Lafayette Hunt, known as H.L. Hunt, was one of the richest men in America. He made his fortune in East Texas oil in the 1930s, buying up drilling rights on what turned out to be one of the largest oil fields ever discovered in the United States. By mid-century, he was a billionaire, eccentric, deeply conservative, and profoundly suspicious of the federal government. H.L. Hunt had 15 children by 3 wives, but the two who matter to this story are Nelson Bunker Hunt and William Herbert Hunt. They inherited their father's wealth, his oil interests, and, perhaps most importantly, his worldview. The Hunts didn't trust Washington, they didn't trust Wall Street, and they certainly didn't trust the United States dollar. Nelson Bunker was the driving force. He was already a major figure in Texas oil, a prominent horse breeder, and a supporter of right-wing political causes. He was not a Wall Street financier. He was a Texan who believed in owning things you could touch: land, oil, livestock, and increasingly, precious metals. For the Hunt brothers, what came next wasn't a speculative trade. It was a conviction. They genuinely believed that the American monetary system was heading for disaster, and that anyone holding paper dollars when the reckoning came would be wiped out. And when you understand why they believed that, you'll understand why this ends in a crash that nobody can stop. Now here's the thing. They weren't crazy. In 1971, President Richard Nixon took the United States off the gold standard. For decades, foreign governments had been able to exchange their dollars for gold at a fixed rate. Nixon ended that. The dollar was no longer backed by anything physical. It was backed by trust. Trust in the United States government and the Federal Reserve. The Hunts didn't have that trust. And through the 1970s, the evidence seemed to be on their side. Inflation surged. In 1973, the Arab oil embargo sent energy prices through the roof. By the late 70s, inflation was running in double digits. The purchasing power of the dollar was eroding visibly year after year. If you put $100 in the bank in 1970, by 1980, it bought you less than half of what it used to. The Hunts looked at this and drew a conclusion that millions of Americans shared. Paper money is a promise, and governments break promises. The only safety is in real, physical assets. Gold was the obvious choice, but gold was expensive. And since 1933, there had been restrictions on private gold ownership in the United States, restrictions that were only lifted in 1975. Silver, on the other hand, was cheaper, more accessible, and had growing industrial demand. It had been used as money for thousands of years, and in the mid-1970s, it looked severely undervalued. So the Hunts made their bet. Not a trade, a conviction. They would buy silver, take physical possession of it, and hold it until the monetary system caught up with reality. This conviction is what made them so dangerous to the market. Most speculators eventually take profits. The Hunts had no intention of selling, ever. And once you understand why they would never sell, you understand why this ends in a margin crash that nobody can stop. To understand what the Hunts actually did, and why it nearly brought down the financial system, you need to understand how the silver market worked. Silver traded primarily on 2 exchanges, the COMEX in New York and the Chicago Board of Trade. You could buy physical silver, actual metal bars, or you could buy futures contracts. A futures contract is an agreement to buy or sell a specific amount of silver at a specific price on a specific future date. One standard COMEX silver contract controlled 5,000 troy ounces. And here's the key. You didn't have to put up the full value. You only had to post a margin, a fraction of the total, maybe 5 to 10%. Think about what that means. With $1 million, you're not controlling $1 million worth of silver. You might be controlling 10 million or 20 million. That's leverage, and leverage is incredible on the way up. Every dollar that silver rises, your gains are multiplied 10-fold or 20-fold. Let's make that concrete. One COMEX contract is 5,000 ounces. When silver moves $1, that's $5,000 per contract. When it moves $10, that's 50,000. And that's before you multiply by the number of contracts. The hunts held thousands. But it works in reverse too. If the price drops or if the exchange raises the margin requirement, you don't just lose money on paper. You must produce cash immediately. If you can't, your position gets liquidated, you're forced to sell, and that forced selling pushes the price down further, which triggers margin calls on other leveraged traders, which forces more selling. A doom loop. Once it starts, it feeds on itself. Remember that, because this mechanism is the engine of everything that follows. Now, one more thing you need to understand. Silver isn't just a financial asset, it's an industrial input. In 1980, the photography industry alone consumed enormous quantities. Kodak needed silver to manufacture film. Electronics manufacturers needed it for contacts and conductors. These companies bought silver futures not to speculate, but to lock in the price of a raw material they couldn't operate without. They had no choice but to participate in this market. They couldn't just walk away. Keep that in mind when it becomes important later. So, the deliverable supply of physical silver was finite, and it was much smaller than most people assumed. The hunts saw that vulnerability. Starting in the mid-1970s, they began buying, and not just futures contracts, they bought physical silver, actual bars, and had them shipped to vaults in Zurich and Dallas. They wanted to take delivery. They wanted the metal in their hands, or as close to it as possible. This was entirely consistent with their thesis. If you don't trust the financial system, why would you leave your silver inside it? They recruited wealthy Saudi investors as partners, adding even more capital to their campaign. By late 1979, the hunts had amassed over 100 million ounces of physical silver and massive futures exposure, enough to distort a market whose deliverable supply was much smaller than people assumed, and the price was responding. Silver started 1979 at around $6 an ounce. By summer, it had reached 11. By autumn, it was accelerating. The very leverage that made this possible, and the same futures mechanism we just talked about, was now working spectacularly in the hunt's favor. This is the mechanism that will eventually destroy them. But in the autumn of 1979, it's making them spectacularly rich. They've now built a position that only works as long as the price never falls. What happens next is what happens when the rest of the world decides to make it fall. Late 1979 into January 1980. Silver goes parabolic. $20. $30, $40. On January 18th, 1980, the London silver fix hits $49.45 an ounce. On COMEX, futures trade briefly above $50. Silver has risen more than eightfold in barely a year. The real-world effects are extraordinary. Across America, people are lining up at coin dealers and pawn shops to sell family silverware, tea sets, jewelry, heirlooms passed down for generations, melted for cash. Tiffany & Company, the famous New York jeweler, takes out a full-page newspaper advertisement publicly condemning the Hunts for what they've done to the silver market. But the people being hurt worst aren't jewelers or grandmothers selling tea sets. The industrial users that are the companies that literally needed silver to function, are getting crushed. Their raw material costs have exploded. They can't pass all of it on to customers. They can't stop buying silver because they need it to make their products. For them, the Hunts aren't heroic outsiders fighting the system. They're a wrecking ball hitting the real economy. And yet, the Hunts aren't selling. Not a single ounce. Because this was never about profit. They believe the dollar will keep falling. They believe silver should be even higher. Their conviction hasn't wavered. If anything, the rally has confirmed everything they believed. But they are about to discover what happens when the people running the exchange decide that enough is enough and change the rules of the game while it's still being played. COMEX takes drastic action. In early January 1980, the exchange tightens rules under what becomes known as Silver Rule 7, imposing position limits and raising margin requirements. It's a warning shot. The Hunts and other large holders are told, scale back. The market barely flinches, silver keeps climbing. So later in January, COMEX goes further. Liquidation-only trading. From now on, you can sell silver futures, but you cannot buy new ones. The only transactions allowed are those that reduce existing positions. This isn't one switch flip. It's an escalating emergency response, and it's unprecedented. Exchanges have broad authority to impose measures like this under the Commodity Exchange Act. COMEX argued they were acting to maintain orderly markets and prevent a corner that threatened systemic stability. And in a narrow legal sense, they were within their rights. But the optics were awful. Critics argued that some board members had direct financial exposure to silver, short positions that were hemorrhaging money as the price rose. They stood to benefit personally from any measure that brought the price down, a potential conflict of interest, to put it mildly. The CFTC would later address this by tightening governance rules for exchange boards, a tacit acknowledgement that the process had been compromised, or at least looked that way. And this is where the story resists a simple telling, because there's no clean villain here. The Hunts believed, not unreasonably, that the dollar was dying, and that they had every right to protect themselves with hard assets. The shorts and industrial users were getting destroyed by a price move driven by accumulation, not by any change in supply and demand fundamentals. And the exchange was staring at the very real possibility of broker failures and systemic contagion if the squeeze continued. Everyone had a legitimate grievance. Everyone could point to the other side and say, they're the problem. But legal or not, fair or not, the important part is mechanical. Once buying is throttled and margins are hiked, the doom loop kicks in. Every leveraged position becomes a liability. Traders must produce cash. If they can't, they sell. That drops the price, which triggers more margin calls, more forced selling. A leveraged corner turns into a liquidation machine, and that machine has been switched on. Rule 7 didn't just cool the market, it reversed the very mechanism that had driven silver to $50 and pointed it straight down. The liquidation machine is running, and the Hunts are about to find out what $1 billion of leverage looks like when it unwinds in a single day. Through February and March of 1980, silver slides. The Hunts can no longer add to their positions. The upward pressure that sustained the rally is gone. But the Hunts are still holding, still leveraged, still convinced they're right. They're not. March 27th, 1980. Silver crashes from around $16 to roughly $10.80. A third of its value gone in a single day. The Hunts' silver-related exposure spread across Bache Halsey Stewart, other brokerage firms, and multiple banks runs somewhere between $1 and $1.5 billion. They cannot meet the margin calls. They simply don't have the cash. And this is where the story stops being about silver and starts being about the financial system. If the Hunts default, their broker Bosch is exposed. Bosch is one of the largest brokerage firms in America, and it has lent against silver collateral that is now worth a fraction of what it was a month ago. If Bosch goes down, its counterparties are exposed. Their counterparties have counterparties. The losses cascade through a web of institutions, each one connected to the next by loans and collateral that is evaporating in real time. Federal Reserve Chairman Paul Volcker, already fighting the hardest battle against inflation in a generation, is now dealing with a potential systemic crisis triggered by two Texas billionaires and their silver hoard. Volcker isn't bailing out the Hunts. He's trying to stop a chain of broker and bank failures that could destabilize the entire financial system. A consortium of banks arranges a $1.1 billion line of credit to stabilize the situation. It's not a gift. It's an emergency measure to keep the dominoes from falling. The immediate crisis passes, but for the Hunt brothers, it's over. What follows is one of the most dramatic falls from wealth in American history. The Hunts lose most of their fortune. Years of lawsuits follow, including civil action by Minpico, a Peruvian mining company, which wins roughly $134 million in damages from market manipulation. Nelson Bunker Hunt declares bankruptcy in 1988. When asked how it feels to lose $1 billion, his answer is simple. $1 billion isn't what it used to be. Silver wouldn't touch $50 again until 2011, but the pattern didn't retire with the Hunts. Anytime you see leverage, a squeezed float, and rules changing mid-flight, you're watching the same movie. The metals, the names, and the exchanges change. The mechanics don't.